want to get to you, Jim Lebenthal, not on GM, but the fact that you've got the market under pressure, you've got this relentless, as I said, rise in rates, and it's putting big-time pressure on stocks, and yet you've raised your year-end target today on the S&P 500 to 4450.
Yeah. So how do
meld those two together?
I will do that. By the way, great discussion yesterday. I know we're on today, but great discussion yesterday. Brian Belsky, Steve Weiss, Joe Terranova on which is right. What do rates actually mean and where are the markets going? So obviously I'm with Brian on this. I think that what rates are actually saying right now, Scott, is that economic growth is a lot better than people expected. Okay. And that matters for top line revenues at companies. Combine that top line revenues with margins that should be bouncing back as inflation comes down, and you're going to see earnings growing again. That's the central thesis of raising the target, is you're going to see earnings growing again. Now, that target for year end is based on where we see earnings next year, around $250 a share. Put a reasonable multiple, 18 times on that, and I do think that's reasonable for the economic growth that we're seeing and for the profit growth that we think we're going to see. So ultimately what I'm saying here, I know we want to talk about interest rates, and we should, all right? There's a lot of reasons interest rates are going up. I'm not ignorant of what's going on with the deficit and supply, but a very big reason that interest rates are going up is because economic growth is a heck of a lot better than expected. And that does flow through to profits, starting with the top line and then with margins, which repair as inflation comes down.
All sounds good. You can make your case as you please, obviously. The question is, if rates continue to move higher, despite all of that, can stocks hang in there or not? Are they going to get slammed as a result? Steph,
Oh, sorry, you want to go to Steph?
No, I want to go to you because I'm just looking at Steph's reaction as I'm asking the question. She knows exactly what I'm alluding to, right? This intense pressure that rising rates are going to put on stocks. Potentially.
It's almost a tautology, right? To answer your question, if rates continue to go up, then no. Of course, stocks can't hang in there. However, and I was saying this to Steph, and you kind of nodded at me before the show. If you look at a chart of the 10-year yield, I don't know if we've already put it up, but it's doing this, right? It's going parabolic. Every single chart in the financial markets that I've ever seen that does that comes back down. Now, I'm not saying we're going back down to 4.35. What I am saying is, even if rates stay higher, it's a question of, have they gotten close to the top? I think they have. So to your question, if they keep going higher, it's a problem. But I think we're pretty close to the top here.
Steph, so what do you make of this price target bump on the S&P to 4450? Whether you think that's achievable, the likelihood that it's achievable, not that, well, anything can happen. Of course, anything can happen, but what do you think?
I think higher interest rates are just a challenge in general for equities, right? Because you can go out in the marketplace, in the fixed income market, and you can get a 4-year muni for 4%. You can get a 4-year corporate for 6.1%. So there's competition, right? For the last 10 years, there wasn't any competition. So you have to start to introduce, is 60-40 back? Is it where you're supposed to be? It all depends on your risk profile and your age, quite frankly. But there is competition, and I think that's one of the reasons why the markets are struggling. I will also say the speed of rates and the fact that it's gone up so fast, that's taken the markets awfully by storm too, right? So, but I do agree with Jim that the rates are higher because the economic growth is better. I mean, the ISM number still in contraction yesterday, but the new orders actually grew, and prices paid actually fell. And today, the JOLTS number, we still have 1.5 job openings out there in this country for one unemployed person. So the job market is certainly still very robust. We'll see what happens on Friday, but Friday's number is backward looking. We look at the initial claims, and we talk about this every week, and that has actually surprised to the upside. So that gives the Fed cover to do whatever the heck they want to do. Is it another 25 from here? Is it 50 from here? They can, because the job market, according to them, they can handle it. We'll have to see. But we are going to slow down because rates really are rising very, very quickly. And really, it's been surprising at how quickly.
Yeah.